let's switch focus. I'm going to talk a little bit about Mahindra Holidays because that one is in focus on the back of Q3 numbers. They were quite a strong set of numbers and long awaited in terms of the way the numbers are starting to play out. Sustainable or not is the big question. But let me first take you through the numbers. Revenue was up around 7% odd on a year-on-year basis. EBITDA was up 39%. Why was that so? One, lower finance costs and also reduction in the other expenses count. Both of those have led to that EBITDA as well as, more importantly, the profit uptick. EBITDA, of course, excludes interest, but when you're looking at net profit, it is up 3x. From 11.5 crore, the net profit number stood a tad bit shy of 35 crores on a year-on-year basis again. And therefore, the margin expansion coupled with interest saving is trickling down to net profit. Let me just quickly look, give you a lens on the numbers. One, you have finance costs which have come down from 45 crore to around 37 crore YOY. It was at 37.5 crore last quarter. It's come down to now 36.9 crore. Also, you're looking at other expenses which is down to 307 crores. Certain cost saving measures from 315 crore, and that's where maybe another 10 crore of saving has come in. And then the marginal uptick on the top line has largely led to the very, very strong numbers when it comes to profit after tax. In terms of member additions though, they were down 36% to 3,000. Sales value was also down. So some of those metrics trending lower, but very positive commentary when we spoke with the management earlier today. 206 keys added, and now cumulatively the base of keys is 5,700 is what they currently stand at. They're planning 15 new destinations with 1,000 keys in the next 5 quarters, and they're aiming to double the inventory base to 10,000 keys. Listen in to my chat with CEO Manoj Bhatt on the quarter gone by, as well as, more importantly, the future outlook and the sustainability of some of these cost-saving measures.
A few comments on the quarter. So if you look at the quarter, I think overall, I think the continued demand trend of people holidaying and enjoying leisure hospitality, I think that continues. And that led to almost a 84.2% occupancy in our resorts. And then that drove, of course, a lot of revenue growth. So if you look at our resort revenue growth was up 12% year on year, which is a very healthy growth. The second point I want to make is that we had committed to increase inventory. I'm happy to say we added about 200 plus rooms in this quarter. And I think there's a clear visibility which we have given that another 1,000 odd rooms would be added by March 26. So clearly that journey of expansion is continuing. Now coming to the numbers themselves, I think from my perspective, there are 3 or 4 key drivers to this business. The first one is occupancy, and I think we continue to see the demand trend continue to be strong. So that's something which will be sustainable. The second one is in terms of just looking at, as you mentioned, the cost side of the equation. I think while that will be variable quarter on quarter, from our perspective, I think we are well on track to create a more sustainable model in terms of costs. And that's something which will not see significant variance. So we are on track from a overall growth perspective in terms of profit growth. The last one I would like to say is that on trying to recalibrate our sales model. And if you see our average unit revenue per sale is also up 37% year on year to about 6.16 lakhs. So from a lot of perspectives, strong quarter, and I do believe that large parts of it will be sustainable.
Okay, I take your point. So, before I go ahead and talk about some of the metrics that Q3 saw, I want a more rounded perspective on how large the market is, because currently your number of members in relative terms is small, but I want to understand what your market size is and what you aim to grow to in terms of number of members, because that will largely drive your top line as well as growth prospects, and which will flow through bottom line.
See, from our own perspective, as we look at the market, I think it's a market of 2 parts, right? So one is really the number of members we have, and the second is the number of members we holiday, right? So I think, so if you look at the first question, right? So we have about 3,03,000 members roughly, and that's in our mind that's like 5% to 7% penetration in terms of the overall market. And when I say that, I mean from a cutoff of a certain income level and certain of the qualifying criteria we use. So if you look at it from our perspective, there are probably 60 lakh households, give or take 60 to 80 lakh households, which can afford the kind of product, and that's the target segment. And that out of that, we are a small proportion. The second thing from our perspective is that I think we are very, very keen on matching availability and member growth. So I think you're seeing some of that matching happen. And that's something which we will continue to do. As we add more rooms, we will be continuing to add members. I don't have a number for you in terms of where we'll be next year and the year after that, but clearly the focus is on growing members also in line with some of the other growth in availability and in our capability to service member in our resorts.
Yeah, that's the other challenge, right, sir? So you suggesting that there is a need to add rooms and therefore accommodate the kind of member base that you have. What would you believe would be the correct number in terms of members to rooms? What should that ratio be in your mind, and where would you want to, or where would you aspire to be?
So we are hovering about 52 or so per member, and I think from our perspective we want to bring it down lower, so probably around the mid 40 levels is what we are targeting. And these are numbers which obviously we calibrate from time to time, because there is a lot of data analytics we do on member holidays and how they utilize our membership, and also depends on location. So there is a kind of a multi-pronged approach here, right? Which locations, which seasons, and how member holiday patterns change.
And what will therefore be the capex required? You're growing by 1,000 rooms on a base of around 5,800, if I'm not wrong. How much of capex is required? How will that get funded? Will that get funded through new memberships? Will that get funded through debt? Are you looking at an equity?
So from, I think maybe from a capex perspective, I'll take a slightly longer term perspective, right? So if you look at, we have said that we'll add 10,000 rooms. From a 10,000 room perspective, as we look at the mix of a capital light and a capex intensive model where we own the resorts, what we feel is that to achieve those numbers, I think our internal accruals should be sufficient, and that's something we are targeting. From a nearer term, I think really as we see, even this year probably we'll end up spending about close to 400 crores in capex, and next year also we will target a number in that vicinity. The other part I want to highlight is that out of the 1,000 rooms, a lot of them would also be capital light in terms of with our partners. That's how we'll expand part of the capacity. So all of that put together, I think from a overall fund perspective, I think we'll be able to fund our own capex is what we feel.
Point taken. And so, last couple of questions. One is you've taken over in somewhere midway last year, maybe not midway, but early last year, current financial year. And therefore, what are the gaps that you are seeing and you are trying to plug as, I can't call you new MD/CEO, but as the MD/CEO now that you've had 7 months to really analyze what is right and what is wrong with the company?
So first of all, it's a fundamentally strong model, right? So if you look at how the company has grown to 3 lakh members and look at the number of resorts, so from my perspective, I would not call them gaps. I would call them priorities. So first priority is, of course, I think in this kind of a market, I think expanding capacity is the number one priority, and that enables us to then grow the member base also much more faster in the future. So that's number one. Number two is in terms of, customer experience. How do we enhance customer experience significantly? And third is probably what I would call as looking at the sales process and looking at what are the markets we want to serve. Because I think from our perspective, serving certain markets where we can actually work with the customer and work with the member on a continuous basis is probably the most important priority.
Okay. And so international has been a bit of a drag in that sense. What are the plans on that front?
So if you look at our international or the European operations is largely in Finland, and I think from a Finnish economy perspective, I think it's going through a phase which is probably from a near-term perspective, it's one of the worst years. But I'm happy to say that if I look at our operations, I think we are holding steady in terms of a small loss which was reported this quarter. And that when I compare that to last year, it has actually improved. So from that perspective, I think we are able to manage even though the environment is tough. So if you look at the overall broader perspective on Europe, I think always we do expect a recovery in the Finnish economy. Now, whether that comes in 2 quarters or 4 quarters is something we'll look forward to. The second is, I think, any potential upsides in terms of geopolitics, because a lot of our Finnish operations was also used by Russians, and that's what caused the decline in profitability about 3 years back. So that's something we'll have to keep a close watch for. But for now, I think it's on a steady path towards profitability, and that's what we're working towards.
Point taken. So last quarter you spoke about how you plan to taper down or discontinue to some extent the 3 and the 4 year product, focus in more on the 5-year product. How's that coming along? And does that change things for you materially with regard to when numbers is concerned? What's the rationale on that?
So I think, first of all, I think as an update, the 3 and 4 years have been discontinued, and all of that volume as a percentage has been taken over by the 5-year product. So clearly the 5-year product has found a very warm reception from potential customers. So that's something which is very, very positive. The second thing is, as we look at the logic behind the 3 years versus 5 years, we felt that that is the time period where members would be able to adequately experience the various range of options which we offer. So that is a better product for them rather than the 3-year product, which has been justified by almost a seamless movement from the 3-year product to the 5-year product.